In this class we'll be dealing with marginal cost pricing. Now marginal cost is the change in the total cost when the quantity produced is incremented by one. When we produce one extra unit of output, the change in the total cost is the marginal cost. In other words, it's the cost of producing the last unit. And that's what we mean by marginal cost. It's the cost of producing the last unit. So it's, if you like, the cost of producing one more good, or if you like, the cost of producing the last unit. In economics, they tend to use very precise mathematics for measuring marginal costs, and in that case the quantity of the last unit produced is seen as very small and insignificant, so it's almost a continuous variable. But we can look at it simply as the cost of producing the last unit, or if you like, the cost of producing the next unit. There should not be a lot of difference between the two. So let's suppose that the variable cost per unit is, let's say it's £41. I've deliberately taken fairly obscure figures here just to illustrate the point. But let's say it's £41. That's the variable cost. It's the cost of the raw materials and whatever other items of costs we can classify as variable. So it's certainly the raw materials included in the production of the product. So £41 is our variable cost. Now let's say our fixed costs are £5,270. Now the cost of 150 units therefore will be 41 times 150, which is equal to 6,150. So we can work out the cost of 150 units. It's 41, it's the variable cost of producing each unit, times the number of units we produce. We produce 150 units, so it's 41 times 150. So the variable cost is £6,150. Now the total cost of 150 units will be the fixed cost plus the variable cost. So the fixed cost is 5,270 as reported earlier, plus the variable cost, which was calculated at 6,150. So if we add both together, we get the total cost, which is 11,420. Now the total cost of 151 units, we've done the calculation for 150. Now we're doing it for 151 units. Now the total cost here will be the fixed cost, which is 5,270, that's fixed, plus 6,191. That's, in other words, it's 151 times 41. Those are the variable costs, 151 times 41. So the marginal cost will be the difference between the two figures. The new total cost, which is 6,191, less the original fixed cost, the original total cost I should say, which was 6,150. In other words, the marginal cost is £41, which shouldn't be surprising because all we did was increase the number of units by one, and we got back to our variable cost per unit, which is 41. So that's an indication of how we could calculate marginal cost. We simply look at the cost for a certain number of units, try to see what would happen if the number of units produced increased by a small amount, let's say by 1, and then we could work out the marginal cost. Now the assumptions behind marginal costing, well, variable costs per unit remain constant. Any increase or decrease in production changes the total cost of output. So it's changes in the volume of production that changes the total cost of output. The cost per unit remains constant. In the previous example, the cost remained at £41 a unit. So it's the volume of output that changes the total cost. Total fixed costs remain unchanged up to a certain level of production and does not vary with increase or decrease in production. So it means that the fixed cost remains constant in terms of total cost. So fixed costs remain unchanged up to a certain level of production. I say up to a certain level of production because we can envisage that if output increases dramatically, the market, let's say, expands dramatically, then overheads may have to be increased. New premises, new machinery, new ways of working, new stores facilities. So there may be an increase in fixed costs because the market has changed. It could be the market contracts, in which case the company downsizes, so fixed costs change downwards. But the variable costs are assumed to be fixed. The variable cost per unit, I should say, are assumed to be fixed. The total fixed cost, these are fixed up to a certain level of output, after which they may vary. So the easiest way to look at marginal costing then is that the cost of making a product, the variable cost, is assumed to be constant, and the fixed costs are also constant. The total fixed costs are assumed to be constant. Fixed expenses in marginal costing technique provide us with the same cost per unit up to a certain level of production. So the fixed expenses in marginal costing technique provides us with the same cost per unit, and that's up to a certain level of production. Obviously, as the level of production within a business varies, and if it varies quite dramatically over a considerable period of time, then of course the fixed costs will change. And also it may be the case that the variable costs are not constant. The variable costs may change as well, because perhaps the sources of material will have changed, perhaps new suppliers will have to be found, and so the variable costs may change, and the fixed costs may also change in the long run. But in the short run, they're assumed to be fixed. Now, features of marginal costing are as follows. Marginal costing is used to know the impact of variable cost on the volume of production or output. So we use marginal costing to check the impact of variable costs on the volume of output or of production. So marginal costing is related to a unit of output. That's what we've got to bear in mind. And with marginal costing, we're just checking what are the costs of making that particular unit. And that's what we mean by marginal costing. Break-even analysis is an integral and important part of marginal costing. We can use break-even analysis with marginal costing, because break-even analysis, which is the subject matter of separate videos, but break-even analysis will look at the fixed costs of the organization and the variable costs, and then compare those to the price and the total revenue to work out the break-even for the business. So this approach of marginal costing is related to break-even analysis, and it's worth looking up some of the videos on break-even analysis to see how that works. The contribution of each product or department is a foundation to know the profitability of the product or department. So it's important that each department not just works on its marginal costs, but also makes a contribution towards the overheads of the business. If the various departments or the various products don't make a contribution to the overheads of the business will not be sustainable in the long run. The business will fold up. It will go out of business, because plant, machinery, equipment, all of these need to be replaced. And the business also needs to invest in product development, marketing campaigns, training programs for the employees. All of the expenses of the business have to be covered. So it's not just a question of covering the variable costs of production and charging a price that meets that. It's a question of charging a price for the product that covers the variable costs and also makes a contribution towards those overheads. Addition of variable cost and profit to contribution is equal to the selling price. So the selling price is the variable costs of making that particular product plus its contribution to overheads. And it's not just a contribution to overheads, it's a contribution to profitability as well. We would include profitability as a type of overhead almost. It's important that the business makes a profit. It's important that the owners of the business receive a return on their investment. After all, that's why they set up the business. If they don't receive a return on their investment, they will not invest. They will not set up businesses. We will not have manufacturing. We will not have businesses. Businesses exist because shareholders put their capital into the business to start the business, to expand the business, to develop the business, but they put it in the anticipation of receiving a return. So the price charged will be the cost of making the product plus a contribution, which is equal to the selling price, but that contribution to overheads is also a contribution to profits. Marginal costing is the base of valuation of stock of finished product and work in progress. And that's how we would value finished stock. When companies produce, perhaps overproduce, and some of the items have to be stocked in the stores, then they would be stocked at marginal cost, at what it cost the business to produce those items in terms of raw materials and variable cost that can be identified that goes to make those products. So the stock valuation will be based on marginal costs. Fixed cost is recovered from contribution and variable cost is charged to production. So the variable cost is the cost of production, and the price that's charged, as I said earlier, will include a contribution to the overheads and profits. Costs are classified on the basis of fixed and variable costs only. Semi-fixed prices are also converted either as fixed cost or as a variable cost. So costs are classified either on the basis of fixed or variable costs. That's how we would classify costs. It's a dichotomy between fixed and variable. And with marginal costing, we're dealing with the variable cost, the cost of making the product. The fixed costs are the overheads, the various departments, the marketing department, the HR department, the research and development department. These are all fixed costs or other costs that are incurred within the business. Semi-fixed prices are also, now semi-fixed prices could be prices that are charged for the product, the marginal cost of the product, that price, but it may also include the contribution. And there may be some flexibility on the part of management in varying that price. Depends on the competitive situation they find themselves in the market. If it's highly competitive, they may cut down the contribution towards the overheads to try and make their product competitive in the marketplace. But they would need to sell more of the item in order to cover the overheads of the business and generate a profit. So it may be they're selling at a low price in anticipation of high volume sales. Really, all of this is to do with management. It's to do with how management can best work out what the pricing of its product should be. Simply charging it at marginal cost pricing so as to utilize unused resources within the business and making sure all the machines and all the people are properly utilized may not be the best strategy. It may be that it's better to charge just below the price currently charged in the market by the competitors to try and win market share that way. Not necessarily charging at marginal cost, which might be a dramatic cut in price. But why not simply charge below the existing price and take the extra margin? So they're covering their marginal cost and they're getting a bigger return towards their overheads. So really it's for management to try and work out what is the best strategy. It's complex. If we look at contribution as equal to selling price minus marginal cost, then of course contribution is equal to fixed expenses plus the profit. And contribution minus fixed expenses is equal to profit. These are the relationships we've been talking about. Now, income statement under marginal costing. Well, let's say we have an income statement and we write it up as an account. So we'd have it for the year ending, let's say the 31st of March 2016 or whatever period. But on some particular day we have an income statement. So we have the amount and the total that goes into the income statement. Now let's say sales were £176,000. We have to take away the variable costs. The variable costs could be the cost of goods manufactured, say 53,671. The variable selling expenses, whatever those are, it may be the cost of postage. Perhaps it's posting out the products to customers, or the cost of transport and accommodation for the sales staff who have to go around and try to sell the products. So let's say we add up all the selling expenses to come to £31,997. So it's the variable cost of expense of selling. These are the expenses. There could be a variable administration expense. The more that's sold, it's more administration, more record keeping, more data has to be kept and filed away and whatever. There may be some administration expenses associated with the sales as well. So if we take away the variable cost, let's say £113,301, then we have a contribution. We've got the sales, we've taken away the variable costs, so now we know the contribution. Now we take away the fixed costs, well, the fixed costs of administration and the fixed cost of selling expenses. I'm doing a very simple account here, a very, very simple income statement. I've only got a couple of items in each. In practice there will be many items and it will be much more sophisticated looking, but the logic is the same as I've got on the screen. So now we've got the fixed costs, which is 40,893, and the profit therefore is 21,806. Now all we've done here is we've taken the sales less the variable costs of production less the fixed costs. We've worked out the contribution less the fixed costs, and we've worked out the profits. So it's a way of working out the profitability using this type of approach. Now the advantages of marginal costing are as follows. Easy to operate and simple to understand. It's simply looking at the cost of making a particular item, working out precisely what does it cost to make a particular unit of the output, and that gives us the marginal cost. It's useful in profit planning. It helps to determine profitability at different levels of production and sale. So we can use the income statement approach we had earlier and try to work out what the different levels of output will cost, and also what sort of profitability we can associate with them. It's useful in decision making about fixation of selling price, how to fix the selling price. Also useful for export decisions and making or buying decisions. It's useful in many contexts. We need to obviously look at the particular market in which the product is going to be sold, the characteristics of the market. Perhaps there are competitors in the market at the moment selling similar products. How much are they charging? And compare that with the marginal cost to see if it's possible just to compete with them. It is useful in terms of break-even analysis, as I said earlier, and it's worth checking break-even analysis and doing a comparison. We'll see here the techniques are very similar. We have fixed costs, variable costs, and the price, total revenue line, and it works out the break-even for the business. Evaluation of different departments is possible through marginal costing. It's possible to work out the efficiency of different departments. How much does it cost to make a product in one department? How much does it cost to make a different product or a similar product in a different department? And perhaps nonetheless it may be the case that one product passes from one department into the next. It's possible to work out the cost in one and then add on the cost in the next one. So it's possible to work out costs throughout departments, particularly if a product moves from one department into another during the production stage. By avoiding arbitrary allocation of fixed costs, it provides control over variable costs. Fixed overheads recovery rates is easy to calculate. Once the company knows what the variable costs are, then it can work out its contribution. Once it knows that the variable cost is, let's say, £10 and it charges £11, then there's £1 towards the overheads. And if it produces enough of the product and it makes £1 contribution from each one, if it makes enough, it'll cover all of the overheads. It'll cover the costs of the business. If it sells a lot, it'll not just cover the costs of the business, it'll generate a profit. Under marginal costing, valuation of inventory is done at marginal cost. That's how inventory is calculated, and I said this earlier, but that's how it's calculated. Now, since fixed costs is not controllable in the short period, the technique concentrates on control over variable costs. So I can't do anything very much about the fixed costs, so it will focus in on variable costs to try and keep variable costs down. But also make sure it's precisely calculating the variable cost. It must know exactly what it costs to produce the product. It can't be ambiguous about that figure. It's a very important figure. So these are some ideas behind marginal costing. This video goes together with other videos on the topic, so please look over the other videos as well and put them all together to see if you've got a better understanding of this concept. Also, highly recommended that you do some reading in the area and particularly check some of the PDFs. But that's all we're going to deal with here, so let's leave it at that and say thank you for watching.